Funding is provided by the USDA Risk Management Agency.
Hello, welcome to the special edition of AgLifestyles. I'm Matt Stum with AgriLogic's Risk Management Education Program for crop producers. Our show is sponsored by USDA's Risk Management Agency. A farming operation's risk exposure comes in a variety of ways. We're going to discuss the current crop insurance products to mitigate two primary sources of risk, yield and market price, for the specialty crops grown in the Northeast. RMA administers several insurance plans and crops which are sold and serviced through private insurance companies that are reinsured by the USDA. Joining us will be Chris Pawelski, a producer in Goshen, New York, and Dr. Mike Fanning and other special guests. Mike earned his PhD in animal science, served as a cooperative extension specialist, and has been the executive vice president for AgriLogic since 1999. Dr. Fanning, tell us about crop insurance.
The basis for many of the insurance plans administered by Risk Management Agency is the actual production history, commonly referred to as APH. The APH is used to determine the producer's insurance coverage, including many of the fruits and vegetables grown in the Northeast.
Could you tell us how the APH works?
An APH is the insured's approved yield determined by averaging each producer's yields history, using up to 10 years of yield. For example, let's look at an apple producer's yield history. When the producer's actual yields are averaged, it results in an APH of 400 bushels.
What if a producer is new or doesn't have yield history?
There are special rules related to new producers or producers who do not provide a complete yield history, newly acquired acreage, and other unique situations which an insurance agent can explain. Your insurance agent can assist you.
So once we have the APH determined, how do we establish the insurance coverage?
We'll begin our discussion with the traditional yield coverage, often referred to as the APH insurance plan. This plan covers yield losses due to adverse weather conditions such as drought, flood, or freeze, and other perils including insects, disease, and wildlife, given good farming practices are applied.
Could you tell us how that traditional insurance coverage works?
Once the approved APH yield is determined, that value is multiplied by a coverage level selected by the producer to determine the insured's guarantee per acre. For example, if the producer selects a 75% coverage level, 75% times 400 bushels results in a 300 bushel guarantee per acre. The 100 bushel difference between the approved yield and the guarantee acts as the deductible.
So if a grower yields less than his guarantee, he gets an indemnity payments?
Yes, I'll explain more. The dollar amount of insurance coverage and potential payments are dependent on the Risk Management Agency's announced price, referred to as the price selection. The producer may select a percentage between 55 and 100% of RMA price selection. For the traditional APH plan, the guaranteed is multiplied by the RMA price selection for the crop type, the number of acres planted, and the producer's share to determine the total amount of insurance. For example, assume the producer has 300 bushel guarantee per acre, has 25 acres with 100% share, and selects a price selection of $8 for fresh market apples. The amount of insurance for the insured units will be 300 bushels per acre times $8 times 25 acres at 100% share, resulting in $60,000.
So how do we determine indemnity when a yield loss occurs?
An indemnity is determined by multiplying the producer's price selection for the crop type by the producer's share and the difference between the total guarantee, which is the guarantee per acre times the number of acres, and the actual production from that unit, referred to as the total production to count. The total production to count includes all harvested production and in-field appraised production, with appropriate adjustments for quality issues. Using the same values from the previous example, assume the growers only produce 4,000 bushels of fresh apples from the unit. The indemnity would be 300 bushels per acre times 25 acres minus 4,000 bushels times $8 times the 100% share, resulting in $28,000.
How does this compare to other crops?
Most crops follow the same procedures.
We have an onion grower with us today. Let's go to Chris Pawelski. Today we're here with Chris Pawelski, a producer from Goshen, New York. We're an hour and a half north of New York City. Why don't you give us a little background of who you are and your farming operation?
Well, I grew up on the farm here in Orange County, about an hour north of New York City. It's an onion farm. And after I finished college, I actually did work in media studies and communication and film, and I did my graduate work at the University of Iowa. After I was married, after a period of time, I moved back in 1993 and have been working on the family farm since then, growing onions full-time since 1996.
All right, so you grow onions, you grow any other crops, and how many acres do you have?
We grow exclusively onions. We grow roughly each year about 110 acres. This year we had 107. It's my father and brother and I. We farm together. We each have our individual fields, but we all work together as far as our resources and our time and equipment and that sort of thing. We've been purchasing crop insurance going back to the early 90s, and my wife and I have been very active over the years to work on the policies, and we've worked with RMA, and it's vital. Without adequate crop insurance, our farm in particular in this area would be out of business.
What inspired you to start purchasing crop insurance?
Well, it was the primary tool available for us as far as managing our risk, and in a certain sense we were baptized by fire. The year we started really purchasing and getting involved, we had a cataclysmic weather disaster, a hailstorm that knocked out half the valley. And we found that as the years have gone by and we've worked on the policy, it's vital as far as managing or controlling our risk. And we've been very proactive in our valley over the last 10 years of understanding the policy, looking into it and seeing ways in which we can improve it and the like. And we've been working with our congressional people and working with RMA and the USDA side.
How was your onion crop this year?
We had rains that came at the wrong period of time, and then we had high heat that followed afterward. And for onions, it basically caused the onions to cook. And we had a great deal of waste this year. And this is not just in our farm, but in the valley. So it's been a challenging year. We have a lot of quality issues and size issues too. We're having to work through it, but obviously it's nice to have some sort of safety net or protection there, and that's what crop insurance provides. My wife is not from a farming background, and for her it's been difficult to deal with the fact that you only get paid at one time of the year at the end of the season, and then all of a sudden you can have this potential of being wiped out and all these bills. That notion of crop insurance and adequate coverage gives her some peace of mind that in case of these kind of events which you can't anticipate and can't expect, she can at least know that we'll be able to pay a good portion of our bills and be able to continue to farm and fight again.
Is there any way for growers to cover their price risk?
Yes, for some crops, RMA offers the dollar plan and the adjusted gross revenue, or AGR, and the AGR-like coverage, which is based on the revenue from the whole farm.
Dr. Fane, which crops of these insurance plans are covered?
The dollar plan is offered for fresh market sweet corn and forward seeding. These plans offer a specific dollar amount of insurance that the insured can select up to. Unique to this insurance plan is that no historical yield records need to be reported to obtain the full amount of insurance. The producer can select the catastrophic dollar amount of insurance or any amount in between the minimum and the maximum allowed amounts of insurance. The producer receives an indemnity payment for the difference between the dollar amount of insurance and the amount of revenue received for the marketed crop and any appraised amount determined by the loss adjuster.
Okay, so how do the AGR and AGR light plans work?
These two plans provide protection against low revenue due to unavoidable natural disasters and market fluctuations that occur during the insurance year for the entire farming operation. Basically, if you suffer a loss in one or several crops, the income from other crops may offset the loss such that, on a whole farm basis, the farm did not have a large enough loss of income to trigger an insurance payment. AGR and AGR Light covers farm revenue consisting of income from agricultural commodities including animals and animal products. The basis for determining the guarantee amount of revenue to be insured is the producer's historical IRS Schedule F tax form and an annual farm report which strengthens program credibility and integrity. These plans provide insurance coverage for multiple commodities during the insurance period in one insurance product using the revenue of the insured commodities to determine coverage and indemnities. AGR can be used as a standalone under certain conditions or used in conjunction with federal crop insurance programs, except with AGR Light. If a producer purchases both AGR and another federal crop insurance program, the premium is reduced. Eligibility requirements must be met, which includes the insured is engaged in the business of farming and derives income from the production of agricultural commodities. A calendar or fiscal year farm tax return must be filed. Amount of insurance cannot exceed $6.5 million. Insured must report the AGR expenses and income histories for 5 consecutive tax years for the same tax entity. Purchase traditional crop insurance such as APH, CRC, if available, when more than 50% of the expected income is from one of those insurable commodities. The purchase of both AGR and traditional insurance plan will result in a reduced AGR premium. Another requirement is that no more than 50% of your allowable income comes from agricultural commodities purchased for resale. No more than 35% of the expected allowable income can come from animal or animal byproducts. There are other eligibility requirements that you can discuss with your agent.
So how do you determine the amount of insurance?
AGR, the amount of insurance, is calculated by multiplying the approved adjusted gross revenue by the producer's selected coverage and the payment rate percentage. Coverage levels and payment rate eligibility varies by the number of commodities produced and are selected by the producer from the county actuarial document. A producer can only select one amount of coverage. As we see here in the table, you have coverage levels of 65, 75, and 80%, with two payment rate options of 75 and 90%. Also associated with those are minimum number of commodities must be produced, with the highest coverage level of 80% requiring 3 minimum commodities being produced on the farm. Also, the maximum annual income, which is not the amount of insurance, okay? So this is your total income on the farm, ranges from $9 million up to $13 million. But it all equals out to the maximum amount of insurance of $6.5 million.
So how are indemnities determined?
Loss payments are triggered when the adjusted income for the insured year is less than the loss inception point, or loss trigger. The loss inception point is calculated by multiplying the approved adjusted gross revenue by the coverage level. Once the revenue loss is triggered, the insured is paid based on the payment rate selected, the 75 or 90% of each dollar loss. As an example, for a loss of payment or indemnity, let's say the producer selects the 80% coverage level and a 90% payment rate, and his approved adjusted gross revenue is $94,900, and the actual farm revenue for the year is $21,000. The amount of insurance would be calculated as follows: $94,900 times 80% times the 90% payment rate for $68,328. The loss inception point is calculated as follows: $94,900 times the 80% results in $75,920. The producer's revenue to count, or the $21,000 from the annual year income, would be subtracted from the loss inception point, resulting in loss revenue of $54,920. The loss revenue is then multiplied by the payment rate, the 90%, resulting in an indemnity payment of $49,428.
Dr. Fanning, how does AGR differ from AGR Light?
AGR Light has similar but fewer eligibility requirements, with the primary difference being the amount of insurance cannot exceed $1 million. As we've seen in the AGR example, they had a maximum insurance amount of $6.5 million, but with AGR Light, it's only $1 million. Another eligibility requirement removed is the limitation on the amount of income for livestock and livestock products, where you had 35% restriction on AGR. AGR Light does not have that restriction. If we look at the table, the coverage levels and the payment rates are the same, as well as the minimum number of commodities to obtain that particular coverage level. But we also see at the maximum annual income, where AGR ranged from $9 million to $13 million, on AGR Light it's a lot narrower window. We only see about $1.4 million up to just over $2 million.
Dr. Fanning, how does this affect the Northeast?
With the recent increases in insurance allowed or the guarantee, AGR Light should work for the majority of the farming operations in the Northeast where this is offered.
Are the indemnities determined differently?
No. Indemnities are still triggered when the adjusted income for the insured year is less than the loss inception point or the loss trigger amount.
So indemnity payment can really help.
Yes, the indemnity payment can be used to help cover the production costs and provide a peace of mind to the grower. You know, the grower has suffered that bad year, that loss, when he got the insurance payment, and it'll keep him in farming instead of having to go out of business and allow him to recover and keep farming in subsequent years. And one other thing that it does as well, it may assist in securing a loan.
Okay, that raises a good point. Let's go to Blaine Allen, a lender. Today we have Blaine Allen. He's a vice president and branch manager of one of the farm credit banks in New York. Blaine, could you please describe your role and the interaction between the farm credit system and the crop insurance community?
Yes, I'm a branch manager in Middletown, and we service lower eastern New York. One of the products that we offer is crop insurance to our growers for them to use as a tool to help mitigate risk.
In your opinion, how does crop insurance help the growers?
It helps the growers as a tool to help mitigate the risk in raising fresh fruit and also onions primarily in our region. And it's a service that's available to them to help take the risk out of the hazards, if you will, of growing, from hailstorms, severe weather, and things like this.
Aside from offering the crop insurance, how do you encourage it?
What we would do is we would meet with our grower and we would go over their financial condition to evaluate how strong they are financially, working capital, net worth, also try to determine what their needs would be for the year to bring the crop in from a monetary standpoint. And then in addition to that, we would also then go over, based on all their financial information, where crop insurance would play a role. And we try to do two different things with our grower. Is we would talk to them about mitigating a risk from a financial standpoint, or our view from a financing standpoint, as well as have the crop insurance agent sit down with that grower and make sure they understand the program, the policy, the coverage, the ability to buy up insurance, so they can make an informed decision themselves as a owner-operator manager to mitigate risk however they see fit in their particular operation.
Previously, you mentioned the idea of peace of mind as an important concept to crop insurance. Please elaborate.
Yes, the peace of mind is twofold. You look at the new rancher and the family farm. The new farmer or rancher, it allows him to enter into agricultural production without a history, to have a safety net, so if he suffers some kind of loss in the first year or two, it allows him to keep farming and keep trying to stay in agricultural production. Helps him to cover his production costs as well as potentially secure operating loans. The other aspect, the family farm. It allows the family farm to stay in the family if they're suffering multiple bad years.
That's interesting. Let's go to a farm wife now to discuss this further. Joining us today is Pawelski. Eve, why don't you tell us about your role in the farming operation?
Well, we view our farming operation as a partnership, and we've divided that partnership in that Chris handles all the work on the farm and you handle all the books.
All right, so do you handle most of the crop insurance decisions or involvement?
Well, I'll research the crop insurance decisions and then we'll talk it over together before we actually purchase a policy.
And how long have you been using crop insurance?
We've been using crop insurance since we came back to the farm and resumed farming, so that's been since 1993.
And how has crop insurance benefited you?
It's been a great benefit because of the policies that are out there. There aren't too many policies for our crop that will cover multiple perils. There's one private policy, but that policy only covers you against one peril, and I would prefer to sleep at night and not have to worry about whether it's going to stop raining, rain too much, hail, or a strike of lightning is going to take out too many of my onions.
So the peace of mind is the important
Yes.
concept to you.
Yes.
When you're going to make the decision to buy crop insurance, what did you consider?
Well, we're looking at two things. We're looking at how much we're going to have expended, how much is going to have gone into the crop, and we're trying to balance that out against how much of a payment or indemnity we would receive if we suffered damage, and balance that out with the cost.
So what are the benefits for crop insurance for you guys?
Well, I'd have to say that one benefit for us is that since we are a monocrop, we get one crop for the year, and that means we get paid once during the year. We have to pay all of our bills and then make sure that there's enough income left over to get us through planting the next season and waiting until we get checks again from the sale of the next crop. So knowing that you've purchased crop insurance gives you some peace of mind that you're going to be able to pay all those bills and make it through until the next year. You know, we unfortunately have actually had to use our crop insurance a couple years because of weather disasters, but the good thing has been that we're still farming, and without crop insurance I don't think we would be.
Eve, you mentioned you had to use your crop insurance. Could you take us through that process?
When there's been a weather event, either hail or maybe for a couple weeks there have been drought conditions and we feel that the crop's going to be damaged, we'll contact the agent and let them know that we have a qualifying event, that something has happened. Usually they'll wait at least 2 weeks to see if the crop's going to come out of that, say if we had hail, before they might come out and adjust the crop. And then you're just looking at your records, which you normally do anyway. You're keeping track of how much is coming in, how much is going out. So at the end of harvest, then you make an appointment with the adjuster. The adjuster lets you know what records he's going to need to see, put them together, and that's it.
Okay, Mike. Now, with all insurance coverage, the big question is, how much will it cost?
That is important. The premium paid by the producer is dependent upon the insurance plan, county, crop, type, practice, and the producer's relative yield risk compared to the county and the coverage level selected. In general, a producer-paid premium can range from 3 to 15% of the amount of insurance.
Does the federal government help cover any of those costs?
Yes, they do. The federal government subsidizes a significant portion of the total premium for the insurance coverage. Let's look at an example. The total premium per acre is equal to the 400 bushels per acre times the 75% coverage level times the $8 per bushel times the 7% premium rate for a total premium of $168. Now, the subsidy for this would be 55%. So you take the $168, multiply it by the producer portion, or 45%, so you have a cost of $75.60 for a coverage of $2,400 per acre.
So the subsidy really makes it more affordable.
Without the subsidy, it would be very expensive.
Dr. Fanning, let's review what we've discussed today.
With the actual production history, or APH plan, this is based on the producer's actual production history, or his average yield per acre. And to establish the grower's approved yield, they used up to the 10 most recent years of his yields to come up with that grower approved yield.
What happens if the grower doesn't have a history of yields?
Well, if the producer doesn't have sufficient yield history, he would need to work with his insurance agent to establish the grower approved yield.
Dr. Fanning, once we have the APH determined, how does this establish the insurance coverage?
Well, once the grower's yield has an approved yield, he then selects a coverage level and a price selection to determine the amount of insurance.
All right, so once the insurance is determined, what perils does the insurance cover?
The perils covered are natural disasters such as drought, insects, disease, and even flood.
Okay, you mentioned some yield perils. Is there any price protection?
Yes, there are some other products such as the dollar plan and a whole farm insurance revenue product called Adjusted Gross Revenue, or AGR, and a program called AGR Lite that would cover the revenue side.
So how does the dollar plan work?
The dollar plan is the amount of insurance is established using an area cost of production, basically using an extension cost of production budget to establish the amount of insurance.
Does a grower need to provide records for this?
The producer does not need to provide any type of expense records.
So a grower gets the same amount of coverage no matter what his history is, or if he has any history of yield records.
That's right. Everybody in the county gets that one dollar amount of coverage that has been set by the risk management agency.
And they can select a coverage level up to that amount.
They can select their own coverage level that they feel comfortable with.
So how does AGR work?
With AGR, that program again is a whole farm revenue coverage where it uses the individual's IRS Schedule F tax form to establish the dollar amount.
All right, once we have the dollar amount established, are there any requirements to be eligible for AGR?
With the eligibility requirements, the producer again has to have 5 years of tax forms. The producer's income cannot be more than 50% from a single commodity. And with AGR, it allows for income from livestock and livestock products, but cannot be more than 35% of the gross income.
What is the dollar amounts available for AGR?
This is going to be based on the coverage level and the payment rate that you select, but the maximum amount of insurance that can be covered is $6.5 million. So based on the coverage level and the payment rate selected, that can vary anywhere from $9 to about $13 million.
So how much coverage does a grower need?
Well, with coverage for the individual grower, that's going to be based on his level of comfort on how much loss he thinks he can incur during the year. So when we're talking about risk and loss is the probability of the crop being damaged. So with coverage levels ranging from 50 to 75%, or it differs for different programs, but how much loss or damage to a crop can he feel comfortable with before he says that that's enough, I can't take it anymore.
And the coverage levels help you decide this?
Yes, again, the coverage levels provided are there to ensure that the producer can stay in production but not necessarily make a profit.
So what do you get for paying this premium?
Well, if we look at the example where we had the $168 per acre premium, the government will subsidize that, and depending on the coverage level selected, the subsidy rate varies. The higher the coverage level, the lower the subsidy rate, and vice versa. So in our example where we had $168 per acre and the government subsidy was at 55%, so the producer pays 45% of that $168, or $76.50. For that $76.50, the producer can return $2,400 per acre.
Thank you, Mike. If you have additional questions, the Risk Management Agency's website is rma.usda.gov. You may also view AgriLogic's website at agrilogic.com/education. AgriLogic will be having on-site crop insurance educational workshops throughout the New York State. Remember, the sales closing date for onions is February 1st. Most field crops have a sales closing date of March 15th, Grapes and apples have a sales closing date of November 20th. AGR closing date is January 31st, and AGR Light has a sales closing date of March 15th. Make sure you contact a crop insurance agent prior to these deadlines in order to have your coverage established. I'm Matt Stum with AgriLogic. Thank you for joining us on AgLifestyles.
If you have a product or service that you'd like to see featured on a future program, or if you have questions or comments, please contact us.